Good morning, ladies and gentlemen. Welcome to the CARCLO PLC Interim Results Investor Presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Just please simply type in your questions at any time and press send. The company may not be in a position to answer every question received during the meeting itself. However, the company will review all questions submitted today and publish responses where it's appropriate to do so. Before we begin, we'd like to submit the following poll, and if you give that your kind attention, I'm sure the company will be most grateful. I'd now like to hand over to Frank Dorringbush, CEO. Good morning, sir.
Good morning. Thank you very much for the introduction. Welcome everybody this morning in the half-year presentation of CARCLO PLC. I'm Frank Dorringbush. I'm the new CEO. My background is around 33 years in the plastics industry, where I've run manufacturing operations, at the end the CEO of RPC BPI Group, and we've done extensive experience in the plastics industry. And next to me is David Bedford, who's our new CEO. David.
Hi, good morning everyone. So I joined CARCLO in September as CFO of the CTP division, and then on the 14th of November stepped up into the group CFO role. I've spent the vast majority of my career to date within manufacturing and engineering, formerly within Jaguar Land Rover, and also 15 years of experience within IMI PLC, the FTSE 250 engineering group, doing a number of different finance director roles, looking after sites and regions. Most recently, I was group FD of Synectics PLC, the AIM-listed electronic security provider. Really pleased to be joining CARCLO at this stage of its development and working to deliver on the operational improvements and see better improved returns for all the stakeholders.
All right. Thank you, David. So we'll go through the introduction of the company, the financial review David will do, and then we'll come back to me to do the CARCLO 2025 project and give you the outlook for the second half year. But first, if you're not so much aware of who CARCLO is, a few little slides on introduction. We've got 13 sites in the US, Europe and Asia. We've got 1,200 dedicated employees, and we got 140 million pounds of sales worldwide. And you see on the chart that our blocks are very nice spread over the complete globe. CARCLO itself is a technology-led precision business with global integration capabilities and operations, and especially the element of the global integrated capabilities we're going to exploit in the near-term future. CARCLO itself, in its T2B business, which is the biggest part of CARCLO, is doing the high precision molding. We deliver turnkey projects for customers. We have clean room facilities throughout the world, and we do automated assembly from multi-part products. The lion's share of our sales and production is in the life science solutions, where we deliver diagnostic disposables, drug delivery systems, and medical applications. You have to put names in like Siemens, Abbott, Bosch, BD, delivering to the blue chip customers. The next part is our precision components, where customers like NCR come in, where we do money dispensing systems, especially also the polymer gears we do internally, also lighting solutions and safety. Then we have two businesses which are we call specialists, like optics, which does light optics, Fresnel's, and the white pack aftercare. And the one who we already have split out is our specialty business, aerospace, which does cable solutions, rotary swag. We do CNC machining of exotic materials, and they are very well placed in a niche part of the business, which will come out later on in the presentation. So this is the company CARCLO. I just want to get to my first impressions in the business. I think we've seen continued growth in challenging times. The first impressions we've seen, if you go to the market position of CARCLO, it's positioned well. It's got blue chip customers. It works in a market which is strong organic growth, especially in our life science segment. We see US as the strongest market, and we see highest growth expectations in the Asian Pacific. Go back to, if we look inside in the operational performance, the margins are under pressure as a result of the increasing input costs. we've got great guys, great teams. We got a good technical operational skills, but the asset base we're having and we have invested in is currently underperforming and it's underutilized. One of the elements is on the tightness of the labor market, which made the recruitment pressure and the retention pressure even higher. The situation in the business is a highly leveraged business with low cash generation, and you have to look at the backdrop of the increasing interest rates. Capital expenditures were mainly focused on growth. We then go to how we have delivered in H1. We have delivered on the opportunity of sales. We had a strong top line growth supported by robust demand in the life science and the aerospace markets. The margin pressure, especially in the technical plastics, has come under pressure due to the cost inflation and the cost of new projects which we are developing. The cash situation, we had a significant increase in net debt, mainly driven by working capital and in capital capacity related CapExes. As the team, we're now pivoting towards a different near-term focus. It's going to be focused on operational excellence in manufacturing to deliver quality, flexibility, and returns. We're doing cash generation through optimizing our asset utilization, which we invested in heavily over the last years, and focusing our current CapEx on continuous improvement, which gives us quicker and higher returns. The pricing has to reflect the new cost reality, both in materials, energy, and inflationary costs. We see for this business a medium-term target of through the cycle of a ROCE of 15%. And as we've made already above 10, we see this as a very, very doable target, especially if we improve our balance sheet position. So I will hand over to David, who will bring you through the financial review. David.
Thank you, Frank. Okay, so starting with our financial KPIs, this slide covering revenue, underlying operating profit, and underlying earnings per share. So revenue in H1 at 72.2 million. So that was 23% up on the equivalent period last year. That did benefit from positive currency. So at a constant currency, the growth was 14%, with 5.2 million of that growth relating to currency. So we've seen really strong demand in the period, both from our existing but also new customers. The underlying operating profit at 3.6 million, that's slightly behind the equivalent figure last year, although up compared to H2 last year. The operating performance is being impacted by margin pressures due to input cost inflation, which hasn't yet been fully offset by pricing. The underlying earnings per share at 1.5 pence compared to 2.5 pence in the prior period. So as well as the operating performance in H1, we have been impacted by higher interest costs, and also in the period there's a tax charge where the prior period was a credit. I'll take you through that in more detail in a moment. Then moving on to the second set of KPIs, the return on capital employed at 7.1%. That's pretty stable on last year's performance. I am expecting to be able to report ongoing improvements in return on capital employed in H2 and beyond as we drive further efficiency improvements in the business, and particularly tighter management of our working capital. The net debt at 36.8 million, that's up 4.4 million since the end of last year, mainly supporting increases in working capital, the further CapEx investment, and I'll cover that in more detail again on the following slide. The underlying operating return on sales at 5%, so that's up on the second half of last year. Obviously still not where it needs to be. We are going to be targeting to drive further improvements in operating return on sales in H2 and beyond as we see the full impact of the price increases coming through in the second half, together with the cost savings coming from the restructuring actions that have been taken. I'll then move on to the segmental performance. So starting with with CTP, which is the vast majority of the business. So strong story there on top line growth. The headline figure with revenues up 22% at 69.1 million. Adjusted for currency, that growth was at 12.9%. And as I said, we've seen strong growth across the customer base. The underlying EBIT of 4 million, that's been impacted by those lower margins due to cost inflation, not yet fully recovered by the pricing. So do expect to see improvements as we go forward. The aerospace business has had another really strong trading performance. Revenues there at 3 million, up 44% on H1 last year. Also good to see a very strong profit drop through on that increase in revenue. The underlying EBIT for aerospace at 0.7 million, that's up nearly 200% on the equivalent period last year. The aerospace business is well protected from inflation because each order is individually priced, so that allows us to pass on the impact of inflation as each piece of business comes in, and we're in a really strong position in that niche aerospace business. This next slide shows the summary income statement. I've already mentioned the movement, the growth there in the revenue. The underlying operating profit at 3.6 million, that's slightly behind the equivalent period in last year, reflecting those margin pressures as a result of the cost inflation. We did have some exceptional items in the half. That 332,000 made up of 1.1 million of restructuring costs, and Frank in a moment will talk a bit about some of the efficiency savings we're making in the division. That shows the benefit coming through of the sale and leaseback of our Tucson site. So following the increases we've seen in base rates, both in the UK, but also US and in the Eurozone, we have got a higher interest expense coming through. And also, as I mentioned, there is a tax charge in the period of 983,000. The effective tax rate in the period is high at 59.5%, and that's high due to the proportion of profits currently being made in higher tax jurisdictions, but also combined with the fact that in the period there were some UK losses on which a deferred tax asset was not recognised. Then move on to the balance sheet. Overall increase in net assets there from 24.4 million at the end of last year to 29.7 million at the end of H1. That mostly relates to retranslation of FX on the overseas subsidiaries. We have seen an increase in gearing in the period, 76% compared to 74% for last year. And in terms of net debt, 36.8 million, that's 4.4 million higher than where we ended the year, with the net debt to underlying EBITDA at 2.5 times, in line with the prior period. So this next slide shows the progression of that 4.4 increase in net debt, starting with the underlying EBITDA, 7.5 million that was generated in the period. So the uses of that going through to fund those working capital increases. I mentioned the further growth CapEx that's been invested in, and also the pension contributions, which are in line with the agreed deficit reduction plan. So those are continuing to come through. Then moving on to the cash flow. So the overall free cash flow in the period was an outflow of 3.1 million. The underlying EBITDA for the period 7.5 million generated ahead of the same point last year. And you can see there those movements in the working capital and pension payments, and the CapEx being the main elements driving the cash flow. And then finally, progress in terms of the pension scheme. So in the last full year, there was a significant reduction in deficit from 37.3 million to 26, mainly coming from a reduction in the level of liabilities following increases in the discount rates, combined with ongoing company contributions. We've seen some further reduction in the pension deficit in H1, at 24.9 million compared to 26 million, mainly coming from further net company contributions. We've also seen a further reduction in liabilities as discount rates have extended, but with an equivalent negative asset return linked to falls in LDI related investments. If we look at the actuarial, the triennial valuation at 31st of March was 82.8 million. That's come down. The estimate at the 30th of September is now at 73.1 million. I'll now hand back to Frank, who'll take you through the business in some more detail.
Thank you, David. Thank you. So we go through the CARCLO 2025, and I think it's good to talk about the segments we were operating in. The lion's share, as we talked about, is life science, which had a massive growth in first half year this year versus first half year of 2022. And the growth was with new and existing customers. And the growth was even despite the fact that the full scale launch of new two product lines has been delayed and will start up later. So they were not included in the first half year sales. In the precision molding, we have been hit by the supply of the microprocessors, so our customers couldn't have the high-end product lines in where we have more components in. The optics business, which it came from the YPAC business, we're now moving it in and expanding it into an in-house range of high-efficient LED lighting. Those precision components and optics are smaller parts of our technical plastics business, but they have performed stable, and the real growth comes from the life sciences. The aerospace itself, David alluded already to, had good sales. We'll show you later on that, however, the sales has gone up by 44%, that they're still not at the pre-COVID level. So we think that the global strategic partnerships we have with major blue chip customers, being in life science, as we mentioned, with Siemens, Bosch, Abbott, and BD, in precision components with clients like NCR. In aerospace, we have to think about Boeing and Airbus. We have good strategic partnerships with them, and that allows us to deliver strong, sustainable growth. We then go to the key input movements. On the left-hand side, you are seeing the raw material prices, and having lived my life in RPC Group, you can't have a plastic business without a graph on raw material prices. And especially when in the half year, which we had as from April 2022 to September, you're seeing that both our engineering plastics and our polystyrene plastics, the orange and the light green ones, have still increased up. And we are seeing a time delay in passing on raw material prices due to the calculation methods, and that has caused a headwind in the margin on the product lines. We're seeing polypropylene starting to ease down. We also use a lot of special polypropylenes where prices are still stable, but at least the growth in prices has stopped, and the availability has become better. Then you see on the right-hand side the soaring cost of energy. We are a very energy-intensive business. You have to do in the last year, we moved over from 100 pounds per megawatt hour to around 300 to 400 pounds per megawatt hour. This forces us to put a energy surcharge through with our customers, and as the whole industry, the plastics industry, is currently confronted with these electricity price increases, especially in Europe, we are successful in putting those prices on. So key focus is going to be operational excellence, back-end automation to also battle off the inflation of the labor cost, and to talk to customers and talk about the pricing to reflect the new cost reality. We see in the near term that the margin pressure will be persistent. So I understand that both David and myself are new for our investors, but the team which is delivering our results are not. It's being consistent of a very engaged, diverse, and international and experienced team, and the amount of years which is behind their name is the amount of years of their work in the relevant industry. Around 80% of our colleagues have made that within CARCLO. We have changed the organization structure to make it simpler, to make it easier, and to minimize the amount of management layers we're having. Our specialized business, aerospace and optics, have their own general management. We have our governance and compliance and keeps us on the straight. And then we moved into global leadership. We moved away from site-oriented businesses to a global leadership. Number one, as always, is CARCLO PLC, our health and safety initiative, which is managed by Ricky. Then we're working on global technology, global sales, and a new function is called global procurement. As we see, if you buy around 90 million pounds of products, we should see a massive improvement in that if we organize that more globally. The sites themselves are run by region. We have the Americas, EMEA, India, and China. They're run by a combination of two people, one person in charge of operations and one person in charge of finance. We do feel that finance should play a more important role on the operations and delivering the growth. You will see, if you got the numbers together, that our working capital, where David already alluded to, in this half year has gone up by 4.7 million. If I look at the last 18 months, it has gone up by 8.2 million. Something with the focus of our finance team being linked directly to our operational teams will help us to improve. The CARCLO 2025, the motto is focus and value. We want to focus on what we do and get the value out of it. We still follow the growth, but it has to be profitable and manageable growth. Manageable growth in our chosen segments, and the massive segments we have the lion's share is the life sciences. And in regions like Asia, as we said, where it's a high growth. We're going to build a one core CARCLO business model, a simpler model which is focused on collaboration, diversity, and entrepreneurialism. We're going to in the next slide explain you why we're splitting design, engineering, manufacturing solutions, because in our opinion, those are two different focus areas. Our specialist segments, as said earlier, talk to the team, aerospace and optics will be run separately by our general managers in those segments. And then the key element is realizing the value which is currently in our asset base. We need to increase the asset utilization. We must improve the performance of our asset utilization and optimize the cash generation of our business. We're sure with these actions we can deliver midterm a target through the cycle of a ROCE of 15%. In the next slide is a small explanation what we mean with one CARCLO. We mean that in our technical plastics, we have two distinct different operations. Our design and engineering, priorly as sales mentioned as tooling, and manufacturing solution, priorly mentioned in products. We see that the design and engineering is a project organization, which is responsible for innovation, automation, and validation of tools. You see the sales and revenue development of that specific segment, which has steadily grown by gaining more projects, and it is a precursor for manufacturing solutions to follow that trend. You also see the massive investment we've done and our customers done with us in the new product lines, which has not been gone on stream, but will be on stream in the very near term. So we have also now set up a design engineering and training center, because it's very important that we become the attraction of talents and people are developing the careers with us. And having a design engineering center and a training center especially dedicated to the technology quality of our business is very important. And as we see, the project business should be separated from the manufacturing operations, because manufacturing solutions is a process business. It's about having global standard and follow global standards, not site standards. We should work on operational excellence. We work on standardization to allow our asset utilization to go up. We do expect around 15% of asset utilization to be realizable in the next 6 months. The growth is with our existing and new blue chip customers, and life science is the lion's share of this business. As we alluded to earlier, in the aerospace, which is specialty, you do see the sales is going up, but you can also see that pre-COVID in H1, H2, 2019, 2020, levels were very close to 4 million, and that is the level we see as achievable in the near term. We then see what we see as a strategic foundation. Like every company, I believe in people. We should be a human-centric organization. Health and safety and environment is the key driver for our value throughout our value chain. We're very proud that the team in the last 12 to 18 months has made major strides in improving the health and safety in our organizations and drastically reducing the amount of incidents we're having with our respective colleagues. But we should be galvanizing our one CARCLO. We should focus on the diversity. Being different together makes a better team. Showing entrepreneurialism and collaboration throughout our sites. And we do see big evidence now in how people are operating. Because CARCLO has to become the destination of talent and careers, because only with the best talents we can make the results we need to do. But we need to make sure we need to first in the business with our talents in a safe way together work on the insight and improve the operational excellence as the base of our business. We should harness technology to make products in a smarter way, increase automation, both from back-end, data gathering, etc. Because CARCLO will be at the forefront of our industry. We cannot do that without our suppliers and our clients. So the focus is to do the strategic partnership and to create and capture the value together. So that was CARCLO 2025, medium-term ROCE of 15%. What do we think in the outlook for the H2? We also see here that the growth projection in chosen markets is continuing to stay strong. The inflationary pressures will continue to persist and will bring the margin to the margins of this period. We do have to say that a big part of the margin reduction is also the time delay of putting prices up to clients versus at the moment that the costs arrive in our business. But the supply chain will remain tight. We see easing up on freight, we see easing up on polypropylene, but in our engineering plastics and high quality metals, we do see that the supply chain is still very tight. Operational excellence projects are being implemented. We're having sites being focused on what they should be doing, and we're implementing that at this moment. We're investing currently only on continuous improvement project and which gives us higher and quicker returns, because that will create quicker cash, because we need to focus on cash management, especially at the backdrop of the increasing interest rates, because they are impacting our finance costs and our ability to move. We expect in the second half to be a similar performance as we've done in the first half. We're very positive on the medium to long term because we're driven by the opportunity of sales, and we are driven by the opportunity to improve our business internally. So that concludes our presentation.
That's great. David, Frank, thank you very much indeed for updating investors this morning. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. But just while Frank and David take just a few moments to review those questions you've submitted already, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, will be available via your Investor Meet Company dashboard. Frank, David, I haven't given you really much time at all, but firstly, if I can thank those attendees on the call for your engagement and for all your questions. If you'll be so kind as to open up the Q&A tab, you'll see you've received a number of questions. And if I could just ask you to read out the questions and then give a response where it's appropriate to do so, and then I'll pick up from you guys at the end.
Okay.
Thank you.
Pre-submitted question, first of all, from Mark. I think this one's for Frank. Could you give more colour about the business plan and the planned investment in new equipment?
Yes, we had a very healthy investment in new equipment over the last 2 to 3 years. I think our current focus is on utilizing the assets we have put into our factory, getting the utilization rate up, and making sure that they are flexible and multi-use, because we need that to be an agile and flexible company towards our clients. So our current focus is on continuous improvement and utilizing the assets we have, and we still see around 15% asset utilization to go up. So for the midterm, to support the growth and the growth potential, we will not be limited by machine capacity. We also don't need to heavily invest it anymore.
Okay. This next question from Mark concerns interest. So asking around guidance in terms of expected interest payments, given the position with net debt and increasing interest rates. So yeah, we did see that increase in interest in the second half. Sorry, in H1 at 1.7 million, and I'm expecting to see that increase somewhat in the second half, depending on whether we see any further increases in interest rates. But going forward with this pivot in terms of the strategy towards deleveraging, we're going to be seeking to bring down that overall level of debt. So for example, you'd have seen in the balance sheet, we're typically running around 10 or 11 million of cash in the business, and at the moment we have the revolving credit of 3.5 million, which is fully drawn. So we see opportunities there in bringing that down, reasonably quickly during the second half, and then to continue generating cash to bring that level of leverage down, reflecting the new reality of the higher interest rates that we're facing. The next question from Philip is asking if you could give an indication of the operating margin that we'd be looking at associated with a 15% return on capital employed.
Yeah, I think the operating margin in a business should be between 8 and 10%. It all depends on where we are. Currently, we're at the perfect storm with a delayed startup of a project, with still high raw material costs, with high energy costs and inflation, and we're currently making 5%. So we're seeing around 8 to 10% operating margin as a basis of a 50% return on capital employed.
I've got a further question here on the pension scheme, and obviously what we've seen there is that significant fall in both the asset level and liability level as a result of the sort of LDI investment strategy. So we've got a first meeting with the what we call the tripartite meeting with the investment trustees alongside the bank. And one of the things we will be getting into in more detail is that investment strategy and the level to which the liabilities are hedged should the discount rates increase further. So that is something we will be getting into, and we'll be able to give you more information on that in further presentations. But certainly we are targeting to continue that progress in bringing down the pension deficit. This next question from Keith is around the margins. So given that FX and interest rate movements have had a big impact on margin, can we see some improvements from the FX and 5-year UK gilt market reversals post-period end? And are there any plans to manage this volatility going forward? So one thing we've already talked about is we need more focus on cash management and treasury within the group. So one thing we will be looking at is whether we can de-risk some of our foreign currency exposures using more hedging than we've done previously. So that's something I will be working on as a priority going forward. So the business is because a lot of our business is in overseas markets. We are very much subject to FX movements. There's a question there: did the pension fund hold any LDIs or face any LDI related issues? The answer to that is yes, and that was reflected in the numbers for H1 with those large swings in both the asset performance and the liability, both moving in opposite directions. But yeah, that is where the that sort of liability-driven investment strategy, with all the turmoil in the market, as you've seen those two large swings, but with an overall reduction in the pension deficit.
Yeah, we'll see a question, why is the management change? It's a fair question. I think we have to focus on what we're going to do for the future. I think the focus on more operational management is something which I bring to the party. I've done that for over 30 years in the RPC group. And yes, I understand I'm only 2 years within CARCLO, but I do know over 30 years of operations in plastics. I think we're very well put forward to have the sales in, to have our positions in, and to have the growth. And we just now have to turn into operational excellence and asset utilization. And that's why we currently have done the changes in the team and make the organization structure with one layer less.
Okay. There's a question here from Sanjay. What is your plan to improve pricing power over and above recovering inflation? And maybe it's worth touching on the surcharges that are coming through.
Yeah, so we currently, I think CARCLO was not really, because we were in a very low inflationary environment in the last years, despite, with the exception of the raw materials. We are now really going out into the market, and we have tested both in April and November the prices and the price increases, which we have been successfully passed through to a big part of our customer base. And what we're trying to see is now trying to get the operational excellence in and make sure that those advances will stay into our organization. On electricity prices, we're going to work with surcharge. And that surcharge has already been implemented in Europe, has been implemented in our optics business, which is in the UK, which we mainly see in Europe. And we're now implementing it from our plastics operations in the UK. And we're running it as a surcharge. If the energy prices go down, the customers will be corrected for that in the future. But we are a very energy-intensive organization, and it's impossible for any plastics organization to have this massive increase from £100 per megawatt hour to 350 to 400 pounds per megawatt hour to absorb that on your bottom line. So your pricing power is also do you do something unique? We're doing something that the whole industry is doing, even our raw material suppliers are talking about energy surcharges. And so we've been successful in our April and November round. We're successful in the energy surcharges in continental Europe, and we're now implementing it into the UK.
Okay. There's also a question as to whether we could give a bit more information in terms of the split of our cost base and how much labour and energy is within that.
Yeah, I think if you talk about energy in a plastics business in general and calculation of differences between 3 and 5% of your cost of your sales base. So if that triples, that's going to be a 10% hit on that individual site. Hence, we need to work with those surcharges.
Okay. There's a few questions coming through around pension. I think this one sums it up. So how are you going to escape from the pension problem and heavy debt burden? So we have an established deficit reduction plan in place, and the business is meeting those payments to bring down the level of deficit. And as you saw from the slide, we've seen some significant progress, both in terms of the accounting deficit, but also the actuarial valuation. So the plan is to continue that as we go through. In terms of deleveraging, in terms of the level of bank debt, the change in focus around profitable growth, but also very much focusing on continuous improvement. We're going to use that to generate higher levels of cash that will provide returns to all the stakeholders. That's very much the priority going forward from this point.
Yeah. I saw a question on, do also our competitors struggle with the supply chain challenges and the energy increases? As I said, all plastics converters use a lot of energy. We take a pellet, we heat it up, form it and cool it down. And that's energy intensive in any of the plastic conversion businesses. So anyone in plastic conversion is currently confronted with this massive increase in energy, and we're all in the market having to ask it back from a customer. We're doing it in an open way. We're taking the gov.uk price level, as that's the price level we also buy upon, and we then charge that to our customers. If the price go down, the customer understands that also the surcharge will go down, and so it doesn't think we have the prices up indefinitely, but it is really to cover the UK prices. And if other people are struggling, I think they have the same challenges as we have in our input costs. As we said, on the supply chain, it is easing out a little bit, so availability gets in there now, and it just allows us to get the product, which was also a problem, say, a year ago. But the high prices are still need to be reflected. And we talked about the time delay of passing the raw material prices on, which has caused a headwind. And if after the meeting you go back to page number 25, you do see that we're constantly behind the curve if the raw material prices keep rising consistently. And we are not the only one. That's in the whole industry. As I've got my experience in that industry. It hasn't never been different, and I don't think the future will be different. These movements have to be done. If it goes down, you get a tailwind, and that's it.
And just one more there around the launch of the new product lines in terms of the expected impact they're going to have in terms of their sales growth and margins.
Yeah, so if you do a new product lines in the life science and medical business, there is a big validation process before we can run the process, because the products we make are essential for the lives and health and safety of the customers of our customers. That means that you have to be very vigilant about what you do. You can't say, I'm going to put it on the market because I've got it ready. We're taking our validation process very seriously. I think that's one of the strengths we have as an organization. We do expect in H2 these projects to run, but at the end of the day, it all runs from that validation. But there is a lot of money invested, even more by our clients than by ourselves, in these new product lines, and we are confident that those product lines will get to the market. The margins of those products the margins in life sciences are strong, they're stable, and we're now seeing with having to put the prices on, we also have some pricing power in that market, that the margins will be positively influenced by that project.
Okay. Just one further question about the underutilized capacity and whether that's the case across the industry. And I think, Frank, in terms of the utilization of the machines are being utilized, they're not being utilized enough hours in the day.
Yeah. So what we do, we track now the utilization of our machines, which is, if we take our worldwide global capacity, and at the moment that we have demand for it, we run around 15 to 16 hours a day. Right? The long run business which we're doing, 18 hours is not an abnormal norm to get to. So if we can get from 15 to 16 hours a day, we can get to the 18 hours a day. That was the 15% of capacity which is inherent in our organization, which we can still use. Then we also, on the two product lines we talked about earlier in the prior questions, those machines are idle and waiting for that project to start. So that those two massive projects have their own machines which have already been invested. But it is the struggle of every business to utilize and sweat the assets, as it is very important for your return on capital employed and your return on sales to have good utilization from them. It all depends which type of product line you run. If you run a lot of different type of products, you have to change your mold very quickly and very often, and you have to color a few times a day. Maybe 12 to 15 hours is acceptable. In the long run business we are in, we have to get to 18 hours.
Yeah. Okay.
That's great. Thank you. I think you've probably taken all the questions there from investors. I know there are a number of a certain theme, so I hope that that's covered that off. If there are any other further questions, obviously we'll make those available to the company, and obviously we'll publish any responses should that be appropriate to do so. Frank, David, I know investor feedback will be important to you and to the company, and I wondered, before redirecting investors to give you their thoughts and expectations, whether I could just ask you for a few closing comments, and then, as I say, I'll redirect investors to give you their feedback.
For me, I think a lot of the opportunity in terms of driving the financial performance are things that we control within the business. From what I've seen so far, I think there's an extensive scope to improve the level of sort of financial management within the manufacturing operations, to drive that better working capital management, better management of our cash and treasury operations, and drive the performance to generate the cash to bring that level of leverage down. So I'm really optimistic about the opportunities that we've got within our control within the business.
Yeah, as we said, we're very positive to the medium to long term outlook. We're currently going through a phase where we have growth in our business, and there is a tightness on the labor market. There is inflation, there's energy cost increases, and there is raw material price increases. So if you could say, are we in a perfect storm? Yes, we are in a very, very challenging situation. So I think the results which the team has created is commendable. And for the medium to long term, we have a very positive outlook. And as David said, a lot of the things we need to improve are in our own hands.
That's great. Frank, David, thank you once again for your time this morning and for updating investors. Can I please ask investors on the call not to close this session, as we'll now automatically redirect you for the opportunity to provide your feedback in order that the company can really better understand your views and expectations. This only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of CARCLO PLC, we'd like to thank you for attending today's presentation. May I wish you all a very pleasant morning. Thank you.
Thank you.